I should have hit record. Um, so part of what we're doing with Mac is that we are applying certain key um, approaches to help startups exit faster and better so that everybody involved, all the stakeholders, get better returns. Okay. We do have some information about this program. It's going to be on a rolling basis and there will be a short application, but the core thing is our 20x application. Okay. So that application I encourage all of you to fill it out. It's free, and you will get a free report back that will tell you what your strengths and weaknesses are. And what you can do is, if you work on what your weakness is, you can continue and you can retake the assessment. You can continue to increase your score, and then you can use it in your data room, right? Because it's just further sort of evidence for potential investors that you're investable, right? If you get a good score. So, with that said, and we're happy to answer questions, and we will have a session about Mac in the future, info session about Mac. But in the meantime, we feel like this is a topic that is very, very important for founders, right? Because a lot of founders, all of you are, when I'm sure my partners have had the same experience. They're like, we're raising pre-seed to build product and we're not even in market. And I'm like, first of all, investors are not going to invest in you until you get something in the market. And then secondly, then they go, we're going to raise, and then we're going to raise, we're going to raise to do this and this. And I'm like, okay, when I first started meeting startups, I'm like, you've told me you're going to raise 5 times, and I haven't heard a single word about revenues because that's the only way you're going to return the multiples that investors want to see, right? So part of this is to help you understand what it means when you raise so much. So Mike is a CEO. I'm going to introduce him in a minute, but there's some faces on the screen that I want to introduce real quick. So Sally is our intern. So Sally, if you could quickly introduce yourself.
Hello, my name is Sally. I'm a sophomore at Swarthmore College, and I'm currently interning with Circle Ventures. Yeah.
And then Pam.
Hi. First of all, thank you, June, because you did a lot of work to get us all here, and I appreciate this. I'm very excited about it. I am one of the partners on this, and my background is around the idea of corporate behavioral psychology. One of the things that's going to help a quicker exit is to actually position the capabilities around your plan for exit and understand the impact of rising pressure. So it's kind of twofold. Not only does it help the capabilities in a stronger way move us to the finish line, but it also manages the pressure we're under. And it's going to be an amazing process when we put those two together, and in partnership with Millimatch and other strategic partners that will help us with the people data. I'm excited about it.
Yeah. And Steve.
Thanks, June. Steve Cohen. I'm a partner in Mac and also founder of Gold Coast Advisors, which is a New York City-based family office and merchant bank. Thank you all for coming.
And then I want to take a moment to introduce Eric Becker, who is the founder of Millimatch. And Millimatch is embedded within our 20x investability assessment, which again, it's free for startups. So all of you take it and you'll get a better insight into how to be more investable. And they measure entire teams. And I was looking for years for technology that could do this. So Eric, I want to let you introduce yourself and Millimatch.
Sure. Eric Becker, I'm the founder and CEO of Millimatch, and ditto what June said. So I'm honored to be a part of the team, and our technology is pretty special. It's measuring behavior and potential in people, in teams. So that's what we do.
And I'm just going to put a shameless commercial in there. For those of you that are in the corporate sector, Millimatch will will help you greatly in your AI transformation. So I strongly suggest you check out their website. So Eric, you can put the website address in the chat.
Okay, I certainly will. Thank you.
You're welcome. And my name is June Choi. I'm the managing partner of Serval Ventures, one of the partners of MAC, of course. And I am very happy to introduce Mike. And I'm going to let him do his own introduction. But we're bringing him in because part of what's always important, because this is what investors care about, is the numbers, right? This is the language of investment. And so Mike is a very experienced CEO, and we're starting to involve him, hopefully, in helping work with startups to really understand the pathway to exit in numbers. So, Mike.
Thank you very much, June. Hello, everyone, and really great to be a part of Serval Capital MAC presentation. As June has mentioned, thank you very much. I've been in investment banking well over 30 years, involved in a lot of structured financing and holding company build out. And I've done this for over 30 years. And most recently, I co-founded Next Gen Advisors. And just for that premise, with regards to the numbers, this was really one of the key areas that I wanted to focus on with founders, is to help them in the capital raise to really understand the core and basic foundation of the raise stages. Thank you, June, for the intro.
Okay, Sally, why don't you start the presentation, and Mike is going to start to walk you through the pathway to exit in numbers, and then we will be piping in with some, hopefully, tidbits of, wisdom. And also,
Thank you.
as we go ahead, feel free to put your questions into the chat. We're not going to be checking the Q&A, so please, we only want to look at one place. So please put it in the chat, and we'll try and answer them as we go along. And also at the end, we will leave a little time for all you to ask questions as well. All right, go ahead, Mike.
Thank you again. So I do in advance disclaimer that please forgive me if this is rudimentary or redundant to some of you founders, but if for the ones that will find this information quite interesting, more than happy to have dialogue after the presentation. As you can see, my email address, michael@nextgenco.com. And this is the startup path to exit in numbers. So as you can see from the graph on the left, all founders should really understand what does it mean from a revenue perspective, time. So there's the TQM model, but there's also how does that translate into your different stages of investing. So and when you should include angels, triple F, which I'll go into, VCs, and other investment organizations. Sally, if you can move to the next slide, please. Okay, so what is capital raise? There's a cycle, a life cycle. Everybody starting from Silicon Valley across all the way to globally, there is a startup life cycle. It starts with an idea, and there's a product that has a demand and the service that's in demand. It could be a software SaaS solution, or it could actually be a physical product. An idea can be redistributed, and there's social media material that explains. But if you came up with an idea that's marketable, today they call it MVP, your minimum viable product. Once you have a minimum viable product, it's still an idea. When does it start to cultivate? Is once you start generating revenue. So as you're moving towards the path of pre-revenue, post-revenue, this is one of the number one question most investors will ask. Are you pre-revenue? Are you post-revenue? And the reason being investable. Most pre-revenue, you're incubating, you're starting out, and there's a maturity of concepts and idea, your typical raise can be less than $1 million, and you need to take advantage of friends, family, and fools. Excuse the latter. And that being said, is generally you can start off as little as 10 grand, 50 grand. This will help you cultivate and mature your product. And then there's the seed round, which I'll go into detail and so on and so forth. So this slide just illustrates the 5 different stages of raising capital. Next slide, please. Okay, what is a life cycle of a startup? Most startups don't make it past the triple F, and the reason being there are simple mistakes that a founder has, and it ends up being what we call in the industry a zombie company. What is a zombie company? There's no market need. The product just basically sucks. Excuse the language. Or you run out of cash. You're unable to fund. But there's a solution for that. Bad recruitment process, concept not fully vetted, metrics are incorrect or inflated. I find this to be the general issue with a lot of founders. And then finally, weak business planning, and the race takes too long, and someone comes up with a better mousetrap. So you're racing against the time to really come up with the best mousetrap. Next slide, please.
And I don't know how many times I've heard, this is the best ever. No one has anything like it. And I'm just like, you probably didn't do enough research, because I guarantee you, and you should operate as if there are 12 other smarter people who are launching the same thing, and you should imagine them breathing down your neck. And that's the only way you're going to win in the market.
Absolutely. Thank you, June. So let's just hone in on the triple F. The triple F stage, which what we call the pre-seed, this is when founders are really pre-revenue and they want to get their MVP up. So a lot of the times they're looking to either bootstrap or go out to family and friends and fools and request for capital injection so that they can complete their MVP. The real true test of an MVP is when you can actually market it in the Apple store, if it's a SaaS, or a Android store for Android users, or if it's an actual commodity product, you can sell it on Spotify or any of the platforms that are out there. And once you make revenue, this is when you're actually moving off of the seed round, pre-seed round, into the seed round. So the triple F, this could be capital from friends, family, investors, founders, but be very weary of bringing in founders or other investors, because the most important key element is your cap table. Your cap table is your market valuation of a company. So you generally, founders start at 100%, which is equivalent to the general standard is 10 million shares. And once you start giving away some of that cap table to other co-founders or other investors, advisors, and so forth, you have to monitor your cap table. This comes very important in the later rounds. Next slide, please.
And even in early stages, if there are, I've heard of investors say, I had to walk away from the deal. The cap table was too messy. There were issues,
Yes.
and we just couldn't make the investment.
Absolutely. Thank you. So here are some key offerings that most investors will provide. So there's equity, which is your common stock, your preferred stock. There's a difference between the two. I can explain. Security tokens, that is usually the equity. And then there's the debt, which is interest notes. So it's a borrow. So you borrow against the equity of the company. You can do security tokens again, which is payable by assets. And then there are what are generally known in the industry, which are convertible notes, or what they call safety or tokens and equity. And then finally, there is the most famous safe agreements, which I highly recommend to do your due diligence on safe agreements. These are agreements in future equity where you need to have a proper accredited valuation before you can offer safe agreements, and that'll come after revenue, of course. So equity can be diluted through the rounds. So be careful, be wary that the dilution does come up in conversation. And this is when a lot of the founders find themselves not planning ahead, and proper planning is essential. Next slide, please. Now, once you start to get into the seed round, as June mentioned, you've already come up with your one slide back, seed round. Sorry, Sally.
Oh, yeah.
Thank you. So the seed round is when the first super angel or micro VC funds, it keeps, yeah. So
There's
here,
lag,
this is
sorry.
when you're, yeah, no worries. This is when your maturity, you have an MVP, your typical raise is anywhere between 150 to 2 million, and your typical valuation is from 3 million to 10 million. Now, the 3 million to 10 million, I can assure you, if you don't have a data room by then, if you don't have financials by then, if you haven't registered your product, if you have not established your board, it will be very complex. And this is where most founders find the rough road ahead, simply because they did not take the proper steps to solidify their company. Typical seed rounds can be done through angels, micro VCs, or in the case of like June from a Mac, where you can have a fund. You can try to subscribe to the fund so that you can get capital to help with your capital rates.
So I'm going to take a moment here to talk about part of what we're
Sure.
doing with Mac. And I will tell you, every investor talks about, what do we look for? Team. And I've asked investors for years, what exactly do you mean by teams? What specifically do you look for? And I've gotten very vague answers. And what we are want to do is help you to have strong teams, so that when investors are looking at you, and it starts at seed stage, if not sooner, right? They want strong teams, and they want to know that you have the people who are going to be able to execute, to exit, right? They're already thinking that out in their head, even though they don't say it to you, right? And so that also includes advisors and, any other people you might have involved.
And June, I think the other thing at this point is, one of the ways that we can help with the data that we have is, as you recruit the next person in this first process, it's very difficult for some of the startups and some of the founders to get that person opposite themselves that they really need. It's hard to get your head around what you could do to ruin your company and bad recruiting policies at this point. And so team and maintaining the team are very important at this point.
Yeah.
Pamela, I couldn't agree more in June. And actually, some of our panel, actually, some of our audience are potential advisors. So, what we would need to do is, if you're an advisor, please let June and Pamela and Steve know, so that we can definitely have further discussions. Next slide, please. Okay, so a bridge round. This comes up in conversation a lot. This is between seed and Series A. Now, remember, Series A is when your valuation is 10 million to 30 million. So in your rally race to get to 10 million, if you don't have a 10 million valuation and you want to have that capital injection to start a Series A, there are what you call a bridge round. So you can continue feeding into your company capital injection until you are eligible for Series A. And the reason why Series A is critical, because this is when you have to be able to register with the SEC. This is when you do your 10K registration. And also, this is when your company becomes a private company, but it is also reportable to the Securities and Exchange Commission. And when you do raises in a bridge round, this can typically close much quicker than a full-blown Series A, and allows startup to have a little bit more time to prepare for their Series A. So if you're about to go into Series A, this is when, if you look at a proverbial channel between, let's say, the US and the UK, and you're in a boat, you're no longer swimming in a lifeboat. You're now really using your company and navigating the waters of capital raises. There are a lot of sharks out there, and those sharks are looking to eat up a lot of your cap table space. What I spoke to in the beginning, be very careful of your equity. Advisors are great, but you have to be able to have the right advisors. And to Pamela's point, human capital is a major disruptor in the capital raise. That being said, once you're fully done with your bridge round and you're ready for your Series A, if we can go into the next slide, you'll see some of the.
Real quick,
Yes,
one, if
sure,
you
sure.
define the 10K for people who may not know what that is.
Absolutely. So 10K is when you have a minimum of 10 million shares of preferred shares that are your company's equity on the cap table. So as a founder, as I started in the beginning, starts with 10 million preferred shares. Those preferred shares are actual equity, which is a part ownership of the company. So when you give out the 10 million preferred shares, if let's say you have a co-founder and you do a 50-50 split, or you might have advisors that you give, 1 million shares, which is equal to 10%. That's a very high number. So a 10K would be when you start to register everyone that has preferred shares, because the next steps, which is a Reg CF and Reg A plus, a Reg A plus is when your company is valued at 10 million or more, you have to register with the Securities and Exchange Commission. Even though you're private, this is part of the requirement to raise a Series A, because if you raise any more than 10 million, a broker dealer will generally have to do the roadshow for you and raise the capital for you. Now, these are the current standards. I'm pretty sure you're all familiar with this, but it's important to know that 10K is the very first step of moving into reporting, financial reporting.
And then just to on the note about bridge raises are still raises. So you're still going to have to give out equity. So even if
That's correct.
people seem to think, oh, we'll just do
That's
a
right.
bridge
That's
raise.
right.
It's simple. No, it's still a raise. So it's the same as any other raise.
Absolutely, and that comes with additional qualifications. And be mindful, right? If you're doing a raise and it's taking you over a year, where you're doing seed round, seed round, bridge, and continuous bridge rounds, either you need to revisit your cap table, revisit your MVP, and understand where there are some corrections that need to be made. And by corrections, I mean you need to have an internal audit, and you need to do a valuation by an independent accredited business valuation specialist. Those type of valuations and audits can help you understand why investors are not looking at you as investable. So a Series A, okay, this is the big leagues. Now you're 10 million valuation into 30. You have your MVP, your net positive in your revenues, and you start to do your projections. Your pro forma is, you might have been starting the company a year to 3 years, and your pro forma is projections for the next 5 years. Investors want to see a pro forma, a pitch deck, and a business plan. Those are the pedigree and mandatory requirements, especially for investors that I've worked with. You need to have a data room. And most importantly, your typical raises can be anywhere between 3 million to 12 million. That's a capital injection, so that it takes you from a 30 million valuation onto the next round. So when you look at these different stages, they're preparing you for the next stage of your company. And if you're valued at 10 to 30 million, that generally means you have a C level as well as B and possibly an A-level human resource staff. So it's important to have the right board. I cannot stress how important a board is when you're doing a Series A, because investors will also want to have a board seat, and they want to have voting rights into the company, even if it's public, is private, excuse me. So in the influx of capital used to help scale as fast as possible, since product market fit has been achieved, typical Series A amounts would be 3 to 12 million, raised at a 10 to 30 million. So what does that mean? As you're, mobilizing a Series A, there's a lot of venture capitalist angel investors. They're already familiar with your raise, and most likely this is when they'll give you a check, and in return, either they look for equity, and or they look for exclusivity to the next rounds. So most VCs and private equity, this is their business. This is what they do for a living. So when you start to have those conversations with PEs and VCs and angel, be prepared to give a chunk of your company.
And can you talk a little bit about, okay, let's say there's like two founders, right? And they'll start out at the early stage with 50% each, right? Then they raise Series Seed, right? And then about how much roughly range do they get diluted?
Excellent point. It varies by the number of investors they bring in. So think of it this way. You have 10 million preferred shares, so each gets 5 million. And as they dilute, for each of the shares is an equivalent to $1. So if you bring in a VC early, or sometimes too early, and the VC wants 20% of your company and they'll give you a check for $2 million, that's dilution. So you'll have to decide between the founders who dilutes. Generally, it's a split, but again, it depends on who's the primary founder and who's the secondary founder. And it also, if you have several C-level on your resource table, the dilution becomes even more complex. And if, like you said earlier, June, sometimes you look at some of the cap tables and it's very busy. Investors don't want to get involved. So generally, private equity venture capitalists, when they see there's more than, let's say, 10 plus pre-seed or seed investors that hold those preferred shares, that also is one of the pitfalls of why investors don't invest, especially like large shops, private equity shops, and VC shops. They want to see a clean cap table, and by clean, meaning it's dilutable.
And but can you give some range of numbers? Like maybe it goes for the
Absolutely,
founders, it goes from
absolutely.
50% to
I've seen where original founders, are holding on to 15 to 10% of the company, and that's at the Series A. Very seldom do you see a very healthy 50-50. Very seldom do you see founders that are 100%. So generally, you give away in the seed and pre-seed round no more than 20% of your company. You should not give up more than 20%, because the choppy waters to get to public or exit gets very, very crowded very quickly. Especially if, I don't want to use the word crowdfunding, but if you're crowdfunding, that's another topic where you can have dilution very quick. So just remember, 10 million is the number. Always keep track of your cap table. And to answer your question, June, and a long-winded, try to stay between Series A and B, an 80-20 split.
and I just want to also put in, I've also dealt with founders who think their shares are worth so much and they're not willing to give anything. But the
Mhm.
reality of the game is you got to give up. Like no one's going to give you anything for free, including advice, access to people. I've built a very strong network, but I've it's my value, right? Part of my value. And it takes time to build that up. And so
Absolutely.
yeah. And people think founders sometimes think money is everything, but money alone isn't going to move you forward. But you also have
Right.
to spend to make. So
Mhm. I, I I couldn't agree more. And this is important. So I did mention the valuation and the audit. So once you're in the Series A and Series B, you should have an accredited independent auditor look at your valuation, and also be able to do what is called a correction. So if the company is overinflated, their projection numbers are incorrect, an audit will reflect that. And it's very important for investors because the investors usually generally either request an independent auditor valuation expert, or they generally um, go out and request it from the founders. So in the Series B, so after the Series A, the subsequent round continues increasing in total fundraise and valuation. So hopefully you could go on from Series B. And mind you, there's a lot of companies. If you go back in history, Facebook went through several rounds because they were organically growing the company. They did not use any ad space until they were valued over $100 million, and that was in their Series C. The most important, the size of the round, due to the large VCs and institutional investors getting involved, continues to increase with each round. So be mindful of your cap table. And obviously, by the time you're in Series A and B, you have investors that come with their own lawyers. And there's a lot of talks about every time you're raising capital, you have to present it to your board. You have to get a board approval. You have to have your financials in a row. And remember, the SEC is going to want to know about all your preferred shares. Remember, common shares is the next slide, which is public. But before we go to there, and the Series B plus is really still, you're in still private stage, and you should be able to work closely with your PEs and VCs and angel to have large checks, but that comes with a price. So if you plan ahead, your cap table should not be diluted to where you're at 10%. And that's one of the biggest pitfalls. You should be around uh, 30 to 20% ownership by the time you do a Series B. If you go into a Series C and D, you're more than likely going to be in the 15 to 10% range of ownership as a founder. Now,
gen-
of course,
generally,
you generally you can, as a founder, I've seen this happen a lot. You can actually buy out some of your prior investors. So if you remember the friends, family, and fools, generally those are prescribed at a much earlier valuation, so you can buy them out. And generally speaking, once you go beyond $1 a preferred share, anyone that you've received money from, you can try to exit them and free up some of that cap space. Next slide. Now, this is the exit. This is where everybody wants to be. And generally speaking here, an IPO can be a raise from anywhere from 100 million. 111.1 is the typical raise. And here's when you have diverse revenue streams. So you have multiple MVPs, or if you have one MVP, this is your general revenue stream. And for post IPO market, when you go into 515.6 million, this was the old number from Ernst and Young. I think that number is still steady. This is really where you generally have a listed ticker, and you can be listed on the NASDAQ, the Dow Jones, and basically you can also have you can be listed globally. depending on where you're registered. Now, when you go from a 10K, once you do the IPO, there's a whole Reg CF, Reg A plus, and there's a whole process in doing publicly traded companies, and that is a whole other conversation because that's your exit. Now, more than likely, if your pro forma and your business plan and your pitch deck has an exit strategy, this is when you're at the end of the line and you're home free, as they say. You have an option. You can either continue publicly trading, and this is when you can raise common stock, or you can look for a company that comes in and purchases all your preferred shares. And this is when the company is diluted, and depending on the 10 million preferred shares, what that market value is at that time, that present time, is when they make an offer for you.
So I think at this point, let's not go any further because if you're at that stage, you're going to have a whole team of people who are going to weigh
That's
in
right.
and advise you about all of this, right? You should
That's
not be
right.
taking advice from us per se, right?
That's
So
right. That's right.
none of this is advice, by the way, um,
Absolutely. Do
about
your own
how
due
to do
diligence.
this, right?
That's
So
right. That's a disclaimer.
yes, yes. So, and part of this is, I think, it used to be that IPO was the goal for every company, but increasingly, good acquisitions are also an exit for a venture company. And I think increasingly there are founders who want to do that because an IPO can take you 10, 20 years easily, right? And with the acquisition, you can get out sooner and cash out. And an acquisition is nothing to sneeze at because what that does is it puts your name dash exited entrepreneur.
Mhm.
And forever, you will be an exited entrepreneur. And that has some serious cachet because every investor is looking for an exited entrepreneur to either invest in their next venture, or exited entrepreneurs have gone on to be investors or joined VC firms, right? Investment firms. There's a number of different things, and it just gives you a whole huge amount of credibility. So, we're presenting this, but we're not saying that IPO is the only exit and that should be your main goal for everybody. For many of you, doing an acquisition, getting acquired is a good thing, right? And so part of what we're trying to do in Mac is we're planning to work with companies to really help you think about in a thoughtful way, what is your exit? And then how do you kind of lay that out, right? So that you are much more clear and intentional and then that will also help you in your strategic decisions along the way. And having that kind of plan, even if it's an outline, what it does is it messages to investors that you guys are really serious about returning their money. You're going to be much more attractive to an investor with that than if you go, I know we'll keep growing as fast as we can because investors know, we know that most of you, the majority of you, are not going to IPO, right? So we're trying to figure out what is your exit going to be and how much money are we likely to get back, right? Make off of the investment in you. So.
Excellent points. Sally, if we can go to the next slide. So the perfect example, and I wanted to show you an illustration. Everybody on this, I don't know if everyone was seeing the Facebook IPO. It was highly touted as one of the most hyped IPO in history. It was listed on
Mike,
May
if I
1st,
could,
2012.
Mike, if I could stop.
Yes,
We will send out this deck and it will be in there. And I think so much of it is well documented that people can look it up. But I want to be mindful of the time and I want to give people a chance to ask questions.
yes.
So,
Sure, sure.
um,
So we can cap it here, but this is a perfect example if you look on the far right, the trajectory of where Zuckerberg went until he IPO'd. And I definitely think, that's where we can cap the conversation. There are additional subsequent slides. They're informational, and more than happy to have further discussions.
So Sally, you can stop sharing. And at this point, if any of you have questions, you can jump in and ask, or if you feel shy, you can put it in the chat and we will read it for you. So one thing is, Eric, if I can put you on the spot, you're an multi-exited entrepreneur. So can you talk about your experience with exits and, some of the lessons that you learned maybe along the way?
Um, Everything that was said here, I had to learn the hard way. So, and I've had 5 previous startups. I'm on number 6, and I'd say the first 2 was the biggest learning lesson there. You are always extremely optimistic in the beginning, so you want to give away the farm you don't have a lot of cash, you want to give away the farm on options to get in people. But understand is that you're bootstrapping it, and the team that you initially partnered up with, maybe not the team that's going to carry you to the next stages, but you've already given away everything and so forth. I will say this is that, and you've heard this time and time again, there is a big difference between smart money and dumb money. Dumb money it's just cash. They bring nothing else to the table. And that's whether they're, seed investors or Series A or anything else. And you'll pay for that later on also. But the biggest thing about exit that I have learned is that you have to have all your ducks in a row as if somebody was coming along with a big check the very next day. Don't wait until you have a letter of intent on the table to get your data room to make sure that your governance is all set and your cap table is clean. All those things are going to delay it and throw up a lot of red flags. So the cleanest way to get through due diligence in either a raise or an exit is to have everything lined up in a row, extremely organized, and everything else. It'll make your life easier for those 2 events, but it's also a discipline within the company also for growth. So
Thank you, Eric. Thank you for letting me put you on the spot.
not
Pam.
a problem.
I was just going to ask his opinion on the idea of the creativity in the middle. When I get some founders that either want to go to the VC too early because they just feel like being a part of that process and given the learning that they're promised that they want to give away the farm and they give it away too early and then they want us to be creative. Could we do factoring? Can we actually utilize some other grant or other way in which we can pull and keep our cap table the way it should be to move into the series? And I didn't know if you had experience with that and had any comments about the people that come in and either ask for or assume there will be creativity that goes beyond just money for shares.
I'm sorry, is that an Eric question or a June question?
Mike
question. Oh, no, it was a Michael question. I'm sorry. I didn't. Yeah, I was just going to say, given you gave all of the phases that you go through, but I've also seen people, especially when they don't want to do an IPO or they sort of get mixed up in the middle when they're trying to keep their cap table clean and they either request or come up with the reasoning and need all this creativity. Have you seen that and how
Absolutely. And the first 10 million preferred shares are the most crucial in your path to keeping a company healthy and stable. I echo Eric's point that this is a trial and error type of process, But if you have the right advisors up front and early, um, it's important, it's critical. Your most expensive asset is your human asset. Your most expensive, and you'll see the most costly, is human asset. You can have an MVP that sells itself, but getting a board ready, getting advisors around you, giving away, the keys to the door, is critical. So make smart decisions early, and learn. There's always a learning factor. I've worked with several founders that came to me already with close to 20 investors on their cap table, and they're in the seed round. I said, "You got to be kidding me. It's unbelievable." So you have to start cutting resources, and stop giving away the keys to the door early.
I I will say one thing. I've seen a lot of healthcare companies, um, very science heavy, research heavy companies, especially like in climate. And for a lot of them, it's like there's no way they can get to market without an infusion, right? So they need to look for non-dilutive funding. And so grants, there are some
Mhm. That's
universities will
right.
support, right? The research and the early sort of testing, right? Because a lot of those companies, they actually have to do some initial trials and they have to get some data back to show that it actually works, the tech, works. And so for that, that definitely, it's not necessarily creativity, but you need to really bust bust your bottom to find those resources and get those first. And actually, investors love that because it's non-dilutive. It also
Mhm.
shows if you get a grant, they know it you have to have gone through a vetting process, right? So you have it shows that you know how to do that. I'll actually put in the chat. There's one group I know of. I think this is what it's called. I'm pretty sure. Um, and this is a resource where you can get access to government grants, but also what they have on their platform, I know the founder, is that they have people who know how to help you write grants because it is definitely a um, very specific talent. So you can find people to help you to do that as well.
And that's a key point
I
that
think
June really put in perspective. You have to plan for these because of the kind of business you are. You can't ask for that creativity later. You can't, I've been in those situations where we're saying, well, how can we claw back some of that and do this and get the factor our receivables and do the things that could get you clean enough to go forward. That's not the place to have that creativity.
I mean, grants take a year
Yeah,
to
they're
get,
not.
right? And even
Mhm.
raises, right? It depends, but I've heard of raises going on for almost a year, right? I think founders seem to think raises, oh, we'll get it done in a month. No, you need to plan. You need to get all
Yeah.
your materials and your data room ready. You need to start having conversations with potential investors. Ideally, like start building that relationship a year or two in advance. So when you're ready to raise, they're ready to come in because they know you, right? And the thing I keep telling people that they seem to forget, people invest in people, right? They're not purely investing in your technology. They're not purely investing in your product or your business. They're investing partly in you, right? And so you have to start building that relationship almost as soon as you can. And I get so many emails
I
from
couldn't
people
agree more.
that are like, oh, we have something you can invest in. And I'm like, I don't know who you are. We're not even connected on LinkedIn, you know?
Absolutely, absolutely. I do, think that this is a very healthy conversation, but the common denominator that I see with founders is the quick rush to raise capital. You need to first plan ahead, even in your prior to MVP. Make sure you know there. I hear a lot. Oh, I want the accelerator program. The only reason why you're looking for an accelerator program is so that you can time to market. But what you really need to do is have a data room, have a cap table, have a pro forma, go through the accelerator, get some money there. You'll get a nice $100,000 check. But what are you going to do with that money? And are you going to invest it in technology or human capital? Right. So you have a lot of chess moves. And if you are smart about your moves, you can really build a very strong foundation.
So,
And like Eric, you know, he's done it multiple times. You know, you become efficient. The key here is efficiency.
so Mike, I want to ask you, and I'm not seeing questions, so I'm gonna keep asking questions until we run out of time or
Sure.
people ask questions. But I want to ask you, and I want to bring Steve in as well, or Pam, anybody else. Um, what can you've gone over the general kind of raise and some of the,
Sure.
pitfalls, but I'd, I'd like you to talk about some tactical, specific
Mhm,
advice about what are some of the best practices or things that you've seen people, founders do that,
mhm.
could help the founders that are here understand what to do better.
I mean, I
I
would say
think
just
liquidity.
quickly before Michael answers, the one thing
Sure.
is to be realistic, and not to be afraid,
Mhm,
especially true with venture firms. Um, Ask what the track record is in terms of investing. Ask when's the last time they invested in a company at their stage. There are so many people out there on the investor side who are taking meetings for the sake of taking meetings, and from the founder perspective, there's no shortage of the amount of time you can waste in those meetings. So just like they're interviewing you, you really need to interview them and get a sense as to, do they fit? Are they real? That sort of thing. And don't be afraid to walk away if they're not.
Mhm.
100%. One of the things I wanted to bring up is commitment letters. So commitment letters are not necessarily cash. They're not. So if you receive the commitment letter, it just means that the investor is willing to date you. But when you start having your raises and you have legal discussions, whether you have a letter of intent or a memorandum of understanding, or a commitment letter, it's really important to do your due diligence and follow up, because a lot of the times that investor gave you a commitment letter, but it just means that they're interested in your MVP. But until you have that wire transfer, you really are just continuing dating, and it could die out. And before you know it, don't assume that that commitment letter is money in the bank. It's not. You have to have the legal teams discuss when that wire transfer is going to happen. There's a lot of platforms out there that can help expedite the process and make sure that when you receive a commitment letter, that you register the shares and you exchange the preferred shares. But until those shares are exchanged, you're just dating.
So, Mike, we have a question here, and Sylvia is asking,
Sure.
how does all this apply to foreign-based founders, especially African countries?
Interesting. I do deal a lot with African founders. I think the most important thing is this is a global view of the capital raise. It's mostly practice in the States and Europe, and Asia. I've seen, capital raises globally. For African founders, I think you just need to make sure it's at the end of the day, it's the basic fundamentals. Are you raising capital? Are you investable? If you're not registered in the United States, I'm pretty sure there are regulations and rules in the sovereign country that you're raising in. Um, you can follow their rules and regulations, but ideally, this trajectory of raising capital is global.
And
Does that answer your question, Sylvia?
I would also say that I have seen so many companies, and my partners and I have all seen so many companies that are in other countries, and they all want to come into the US market, right? To raise and to get into the market, partly because there are more VCs here than anywhere else, right? For instance. Um, but a lot of them aren't really prepared to invest. And I will tell you, most US investors do not want to invest in foreign entities because of
That's right.
tax issues, whatever, right? So most companies, if you're serious about investing, you want to either form a US entity, which can be very
Mm-hmm.
costly and expensive to maintain. But what we also are exploring with companies, going to be exploring with companies in the MAC program is how can you form partnership? Because really the best thing would be to have a US based partnership. And I can't tell you when I say this, how many people are like, yes, yes, and it is been affirmed over and over, private equity, venture, everybody, right? And lawyers, you name it. So, um, you know, you need help and you need to think about it properly.
Sylvie, I think what you need to June's point, just to add a little bit more, a U.S. presence is essential. There are certain trust setups where you can have a U.S. presence and you can have a bridge trust in the other countries. But I couldn't agree more with June. The legal side of things make it complicated, so you definitely need to have that US presence because investors will not invest in you. If you're an international company, you should have a presence in the US.
And I'm sure there are some people that think they're really smart and really cute, and they're thinking, oh, we'll just form something in the Caymans. And I will tell you, I have heard about investments that have not happened because that came up in the due diligence, you know?
That's right. That's right. Very good.
Okay. Anybody else have questions? The IPO will be in the NASDAQ. That's what Sylvie's asking. If there's an IPO, would it be in the NASDAQ?
It depends because if it's a fintech or a SaaS, most technological companies register in the Nasdaq. The New York Stock Exchange is mostly for commodities, and there are other S&Ps and other indices. But ideally, if you're doing futures, it's NYMEX. But if your company is a technology company, more than likely you can IPO in the Nasdaq. Yes. Eric, you wanted to say something?
Are they going to run a background check for IPO? Because if that's the case, I'm out. Yeah, I'm not going IPO. Just, parking tickets are out of this world. So,
So we are at time. I want to thank everybody for joining us. Thank you. Thank you, everybody that participated actively. And also, finally, I want to thank Mike for doing this for us and putting together the deck for us, the illustration. We will be sending out, for those that registered, a recording as well as a copy of the deck. And we will send you some additional information about Mac as well. So please, one thing we ask is that you share it with anybody that might get value out of it, right? So this event is free because we want to make startups stronger, better informed, more knowledgeable, but help us spread the word. Okay? All right. Thank you, everybody. Have a great day.
Thank you. Thank you so much.